objectives, we'll be looking at the preparation of financial statements. We'll be looking into profit versus non-profit entities. We'll be talking about that very briefly. Then we'll be touching on accounting standards. We won't go into details a lot. Then we'll try and solve a question when we have some time. So let's move into it. So in preparation of financial statements, there's one key standard that you need to know, which is IAS 1. IAS 1 talks about the presentation of financial statements. It talks about how to present it. And it's for IAS 1, it says that a financial statement is complete if it comprises of 1, a statement of financial position, which used to be the balance sheet; 2, a statement of profit or loss and other comprehensive income, which used to be the income statement; a statement of changes in equity; a statement of cash flows; and basically accounting policies and explanatory notes. So these 5 things will come together to form a complete set of financial statements. Very, very important. So when you are presenting a full set of financial statements, these 5 things must come together. Then let's talk about exceptional items. There are some items that are exceptional. So here I define an exceptional item as is a name given to material items of income and expense of such size, nature, or incidents that disclosure is necessary in order to explain the performance of the entity. So these are items that must be disclosed. If we are going to understand the performance of the entity properly, these are items that we need to disclose or explain or make known so that the users of the financial statements will know. So what is the accounting treatment? The accounting treatment is to include the item in the standard statement of profit or loss line, right? You include the item, the exceptional item, in the standard statement of profit or loss line. And you also disclose the nature of the amount in the notes. You need to explain, that's what the purpose of the notes. The notes are explanatory, like we said previously. In some cases as well, for distinctive purposes, it may be appropriate to show the item separately, on the face of the statement of profit or loss. You show it separately. To make it more distinct. You want it to be clear so that the users of the financial statement can actually see it and be able to locate it, and you need to make it explanatory as possible. Examples of exceptional items include write-down of inventories, impairment of property, plant, and equipment, restructuring costs, discontinued operation, litigation settlement, reversal of provisions. These are items that are exceptional, and you need to provide more insight. You need to provide more explanation as to their nature, the incidence, and the size. 3 things: the size, the nature, and incidence. You need to give more details around that. So let's look at the format of the statement of financial position, right? Let's look at the format. How does it work? So this is a typical statement of financial position. First, you have your assets. Your assets are broken down into 2, non-current and current. The reason why non-current comes at the top is that it's based on how illiquid it is. For current assets, you are able to convert into cash quickly. Able to convert to cash quickly within a 12-month space. And so that is a lot more, it's a lot more convertible into cash. So the illiquid items are at the top when it comes to assets. So non-current assets, converting it into cash takes a while. Current assets is a lot easier. So the illiquid items, those items that have a difficulty in converting into cash are at the top. So that's why you see non-current assets at the top. And those where we have an ease of conversion into cash is below. That's why you see current assets. Current assets are easily convertible into cash. So illiquid at the top, liquid items below. So let's start with non-current assets. We start with property, plant, and equipment. You have investments, intangibles. All these are non-current assets. So I'm just walking you through the format so you have a brief idea so that when we zoom into the question, we just, go. Then under current assets, you have inventories or stock, you have trade receivables, you have cash and cash equivalents, we have assets held for sale. So you add current assets and non-current assets, and you should have your total assets. Then you have equity and liabilities. Equity is also known as capital. So under capital and reserves, you have your share capital, you have any retained earnings, you have other components of equity, and that gives you your total equity or your capital. Then you have your non-current liabilities, right? Then you have your non-current liabilities. So we are moving to the liability section. The non-current liabilities, you have your long-term borrowings, you have your deferred tax. And the current liabilities, you have examples like trade payables, short-term provisions, short-term borrowings. And when you add equity and liabilities, you should also get a total. Now, per the accounting rule, you should always remember this. The total assets is equal to the equity plus the liabilities. So it should balance out. Everything should balance out very nicely. So basically, that's the statement of financial position structured in this way. We are talking about presentation here. We're talking about presentation here. So this is very, very important. This is very, very important. So let's talk a little bit about classification of an asset and liability. Fortunately, IAS 1 gives us that information. So note that IAS 1 requires an asset or liability to be classified as current. So when we say a current asset, current liability, what does it mean? It means that it will be settled within 12 months of the reporting date. Remember the 12-month mention I made earlier. If it will be settled within 12 months of the reporting date, then you classify it as current. So always remember the 12-month threshold. 12-month threshold. And number 2, it is part of the entity's normal operating cycle. So these are the two things that distinguish between current and non-current. Current and non-current. Current and non-current. Very, very important to understand. Very, very key. Very, very key. So if it will be settled within 12 months of the operating date, of the reporting date, then it is a current asset or a current liability. If it is part of the entity's normal operating cycle, then it is current as well. So that's the definition. So the opposite applies for non-current, right? The opposite will apply for the non-current. Within the equity section of the statement of financial position, other components of equity include things like revaluation surplus, share premium, investment reserve. All these are components of equity. Then let's talk a little bit about the statement of changes in equity. That's one of the areas that can be a bit confusing for some people. So the statement of changes in equity, it simply provides a summary of all the changes in equity arising from transactions with owners. All the changes in equity. This includes the effect on share issues and dividends, basically. It includes the effect on share issues. So I'll show you a typical example of how the statement of changes in equity, and you see how the changes occur in the owner's equity, the changes occur in capital, and the impact it has on share issues and dividends, basically. So let's talk about the statement of changes in equity. Now, all this will come together when we solve a question. So just please take and stay with me. It's going to be very, very simple for you to understand. So this is a statement of changes in equity. Now, you realize that at the top, you have the share capital, you have the share premium, you have the revaluation surplus, and you have the retained earnings, right? So remember that when you invest shares, there might be a share premium. There might be a share premium. You also need to factor in revaluation surplus. You also need to factor in retained earnings. All these things impact equity. Always keep that in mind. All these things impact equity. And an acronym I use to remember very, very well, helps a lot, is SSRR, which is share capital, share premium, revaluation surplus, retained earnings. S stands for share capital, S stands for share premium, R stands for revaluation surplus, R stands for retained earnings. So SSRR. Then based on that, you have your total equity. So first of all, you start with your balance. This one, we are preparing it for the year ended 31st December 2008. So we are going to look into the balance as at 31st December 2007, and put it there. If there are any prior year adjustments, we also include it. Then we talk about dividends, we talk about issue of share capital, and we talk about any impact on retained earnings. So if there are any transfers to retained earnings, we include that. So this is basically how a statement of changes in equity looks like. And like I said, we'll solve the question so that it becomes a lot easier and relatable for you to understand. Now let's look at the statement of profit or loss and other comprehensive income. The statement of profit or loss and other comprehensive income. So total comprehensive income is the realized profit or loss for the period, plus other comprehensive income, right? So other comprehensive income is income and expenses that are not recognized in profit or loss, but they are rather recorded in reserves. So they are not recorded in or recognized in profits and loss. That's why they are called other comprehensive income. Other comprehensive income. So for the purposes of financial reporting, other comprehensive income includes any changes in the revaluation of non-current assets and fair value through other comprehensive income financial assets. So any changes that are occurring in the revaluation of non-current assets, it's other comprehensive income. So basically, we are grouping the full statement of profit or loss and other comprehensive income into two sections. So there's a profit and loss section, and there's the other comprehensive income section. So the other comprehensive income section is income and expenses that are not recognized in profit or loss. They are recorded in reserves rather than as an element of the realized profit for the period. So they are recorded in reserves. Keep that in mind. They are recorded as reserves. They are not recognized in profit or loss, but they are recorded in reserves. So IAS 1, which is the presentation of financial statements, require that you prepare either a statement of profit or loss and other comprehensive income, or you prepare a statement of profit or loss showing the realized profit or loss for the period, plus a statement showing other comprehensive income. So IAS 1 is saying you need to have those two things in place, the profit or loss and the other comprehensive income bits, basically. So what are we saying in this slide? There's a profit or loss section, which shows the realized profit or loss for the period. And there's the other comprehensive income section, which is basically recorded in reserve. These are reserves where you record things like revaluation of non-current assets, etc. So yeah, it's pretty simple, and we'll be delving into a question which would help us understand exactly what is going on. So let's talk a little bit about not-for-profit and public sector entities. Then I want us to focus on profit-orientated businesses and not-for-profit orientated businesses. There are entities that exist for profit, and there are entities that also do not necessarily exist to make profit. That's not their primary aim. So the profit-oriented ones, the first difference between the profit-oriented and not-for-profit oriented is that the financial aim is to make profits. For the profit-oriented ones, they need to make profits. For the non-profit ones, they need to achieve value. They need to provide a service. For the profit-oriented ones, again, the directors or the managers are accountable to shareholders. For the non-profit ones, the managers are accountable to trustees, they're accountable to the public, or they're accountable to the government. Very, very key. For profit-oriented companies, External finance is freely available in the form of loans and share capital. For non-profit entities, finance is generally limited to donations and government subsidies. So you see the differences. The first difference is in profit. Second difference is in accountability. Who are they accountable to? Third difference is in financing. Where do they get the money from? So profit-oriented versus non-profit oriented. One is more focused on profits, making money. The other is about service provision. And in terms of accountability for the profit-oriented businesses, the directors are accountable to shareholders. Non-profits, the directors are accountable to the public, trustees, or the government. For profit-oriented, again, external finance can be raised from loans and share capital. For non-profits, external finance is usually raised from donations and government subsidies. So very, very key. Please keep that in mind. Then let's move on to accounting standards and not-for-profit and public sector entities. So accounting standards are designed basically to measure financial performance accurately and consistently. That's the whole purpose of accounting standard, right? Think about a standard. So they help to measure financial performance accurately. They also help to report for financial position accurately. And they also help to account for the director's stewardship of resources and assets. So they help to measure financial performance accurately. They help to report the financial position accurately. Again, not-for-profit entities do not have an aim to achieve profit, but they still have to account for their income and their expenses or their costs. Their aim is not for profit though, but they need to account for their income and cost. They need to account for three things, which I call the 3 E's: effectiveness, economy, and efficiency. Effectiveness, economy, and efficiency. Effectiveness, economy, and efficiency. Very, very key. Very, very key. Very, very important. So they need to measure how effective they are with the management of resources, how efficient they are with the management of resources. Also, non-profits and public sector organizations, they do not necessarily have to produce financial statements for the public, but in many cases they do so just for accountability purposes. And some measurement accounting standards will be relevant, such as those relating to inventory, non-current assets, leasing, etc. So this is a gist about accounting standards and how it relates to non-profit and public sector entities. Very, very key. Very, very key. Very, very important to understand. Very, very important to understand. So at this juncture, we would take a break, and in the subsequent video, we'll be talking a lot more about a question. We'll solve a question. We'll bring the concepts we've learned here home by solving a full question to understand how everything relates, from income statements to the balance sheet to the statement of changes in equity. How can we bring all of these things together? That's the main thing. I just wanted to set the theory and the foundation, right? Then in the subsequent video, please watch that, because that will definitely help you. We'll bring that home. So thank you. Please hit the subscribe button if you haven't, and also hit the notification bell so that anytime I post a video, you would get it. Thank you.